If you have spent any amount of time trading on charts, I can guarantee that the single biggest problem that you are facing is finding the perfect entry. My name is Nick and I'm a multi-7-figure trader with an 80% historical win rate trading live in front of thousands daily. And I have absolutely nothing to sell you. When I first started trading, I remember spending hours on the charts drawing stupid numbers of boxes and lines, thinking one day I'm going to get rich doing all this. I placed losing trades after losing trades for months on end, losing tens of thousands of dollars in the market. Then one fine day, I discovered the perfect entry model that can be used for any chart at any time, compatible with any strategy. That's the purpose of this video. I'm going to strip away all the useless fluff and go deep into the exact universal entry model that I have used for many years to snipe perfect entries consistently. What I'm going to cover here in this video is going to be the necessary concepts that you need to master in order to execute this model. Internal range and external range liquidity, or IRL to ERL. We have gone over this concept over here in this previous video, but I respect your time, so I'm going to condense the most relevant parts of that video here. So without further ado, let's get right into the video. The market moves by doing two things: seeking liquidity and offering fair value. Seeking liquidity means that the markets are out to target previous swing highs and swing lows by taking out stop losses at these areas and using them as liquidity to fuel the next move. Offering fair value essentially means price comes back into a key area of supply or demand, like mitigation blocks, fair value gaps, order blocks, or to put simply, places with pending orders. Now, the market moves in a cyclical nature, from offering fair value by collecting orders to creating erratic movements to seek liquidity. Now, let me show you an example of how price always offers fair value and seeks liquidity in a cyclical manner. Here on the silver chart, price created a bullish fair value gap, at which fair value has been offered for price to react off as seen in point number 1. After rejecting at the bullish fair value gap, price targeted the swing high at point number 2. Which is how price is seeking liquidity by taking out the stop losses above this swing high. After breaking this swing high, we noted that price has created a bullish order block on the daily at number 3, which is where fair value is offered yet again to react off to target the previous swing high, seeking liquidity on the daily as seen over here at point 4. Keeping things simple like this will allow you to avoid all sorts of confusion, messy charts, and just keep trading minimalistic yet profitable. The markets are already complex enough. Our jobs as a profitable trader is to keep trading as simple and focus on the only few things that actually makes us money and cutting the rest of the noise. For this entry model to work, I really want to open your eyes to two things. Focus on these two concepts and I assure you, your whole perspective and the way you view the markets will change forever. There are two types of entry models. Number 1, lower time frame or day trades. And number 2, higher time frame or swing entries. I usually day trade on live streams, but I've been doing swing trades recently and I've been absolutely loving it since these entry models work just as well on both. Now, let's start with the lower time frame entries, my bread and butter. Let's take a look at this chart right here. We have the daily chart on the Australian US dollar. Now, let's quickly recap a key concept I've mentioned in previous videos. The IRL, or internal range liquidity, and ERL, the external range liquidity. Internal range liquidity are things like your fair value gaps, your breaker blocks, and order blocks. To put simply, these are points in the chart with a huge number of unfilled pending orders. If you're unsure about any of these concepts, I would strongly suggest you watch our previous videos over here. These videos will help explain these concepts in depth. But just a quick recap. Fair value gaps are a 3 candlestick pattern with a gap created by the first candlestick and the third candlestick, as seen over here. The gaps created leaves a lot of unfilled orders, which often get retested by price. Order blocks, on the other hand, are areas with a huge number of unfilled buy or sell orders. And when price taps into the order block and reverses strongly. Again, if you want a more in-depth explanation of these concepts, I've done multiple videos explaining them. So just make sure to click on this right here and you'll be able to go ahead and watch and understand exactly how these order blocks work. External liquidity refers to swing high and swing lows. Swing highs are highs with a lower high to the left of it and a lower high to a right of it. For example, on the Australian US dollar chart, this is a swing high over here. As you can see, to the left of it and on the right of it, price forms lower highs here and here. This is also a swing high for the same reason. There's a lower high over here and another lower high here. Conversely, swing lows are lows with a higher low towards the left and the right of that specific swing low. This right here is an example of a swing low with a higher low over here and another higher low over here. Now, let me circle back to the main topic, finding perfect entries. To find the perfect entry, you need to understand how the market moves. Price goes from internal range liquidity to external range liquidity. This comes together with the central idea mentioned previously that price does one of two things: offering fair value at internal range liquidity and seeking liquidity at external range liquidity. The IRL in this case is the fair value gap over here, which is created by the 3 candlestick pattern as seen here. Remember, fair value gaps are created by the gaps between the wick of the first candle here and the wick of the third candle right over here. This is an area of many unfulfilled sell orders. This fair value gap overlaps perfectly with this mitigation block created over here. This area here is a mitigation block because it is the last significant structural low where buyers at these levels are able to close their orders when price comes back to their break-even level, causing a build-up of sell stop orders since many buy orders are closed here at break-even. From this, we can deduce that price will likely go down from this mitigation block, overlapping with a bearish fair value gap to all the way towards the swing low right over here. Very simple. IRL to ERL. Internal range liquidity to external range liquidity, which is our target. Now, to the actual meat and bones of the video, the entry model. We've established our IRL to ERL being the daily fair value gap overlapping with the daily mitigation block, all the way targeting to this swing low over here. Now, here's where you need to pay close attention. You will have to drop down to the lower time frame after plotting your IRL and ERL on the higher time frame. This ensures that you have sniper entries since you get more information on the lower time frame compared to the higher time frame. The time frame alignment you should be using is as follows. If you're using the monthly PD array, you want to use the daily entry or 4-hour CT entry. If you're using the weekly PDA, then you want to use a 4-hour entry or a 1-hour CT entry. If you're using the daily PDA, you want to use the 1-hour entry or a 15-minute CT entry. If you're using a 4-hour PD array, you want to be using the 15-minute entry or a 5-minute CT entry. Now, this time frame alignment is something you see all over my channel, with the exceptions of the word CT. Now, what in the hell is CT? CT stands for clean traffic. Bullish clean traffic is where we have a swing low to a swing high that contains a fair value gap in between. A bearish CT is where we have a swing high to a swing low that contains a fair value gap in between once again. Since you are moving away from the daily fair value gap to the daily swing low, we can use either the 1-hour entry or the 50-minute clean traffic entry, CT entry. Let's take a look at the 1-hour entry. This box over here with this line is our daily internal range liquidity from the fair value gap created on the daily time frame. This line below over here is our daily external range liquidity based on the swing low. With the time frame alignment, we are looking for a 1 hour fair value gap confirmation in the direction of our IRL to ERL. So in this case, we'll be looking for a bearish 1 hour fair value gap. After waiting for a few candles to form, we have this 1 hour bearish fair value gap right over here, overlapping with a 1 hour structural low. I then decided to place a sell limit at the overlapping area of this fair value gap and the structural lower low, with stop loss at the most recent swing high, and take profit targeting the daily ERL. Now let's see how this trade plays out. And there you go, an easy TP smash. Let's take a look at the 15-minute clean traffic entry now. The clean traffic entry we would be looking for in this case would be a bearish clean traffic. Just a quick recap. We're looking for a swing high to a swing low that contains a fair value gap in between. The thing that differentiates the CT entry to the regular entry is the fact that we need two clean traffics to have a valid entry. So let's take a look at what that actually looks like in the chart here. Earlier on, we marked out this area with this line here, our daily IRL. You can see that we have our first clean traffic right over here. Swing high to swing low with a fair value gap in the middle. Now, all you have to do to enter this trade is a further confirmation of clean traffic since we are on the lower time frame. If you look closely, we get the confirmation right over here. All you have to do now is enter at the start of this fair value gap, with stop loss placed above the most recent swing high, since this trade will be invalidated if it crosses past this swing high. What you want to do is then place the stop loss at a 1:2 risk to reward ratio, meaning for every $1 that you lose based on your stop loss placement, you earn $2 for a full take profit. And let's see how this trade plays out as well. There we go, TP smashed. Now, here's where the fun begins. You can continue with this CT price licks until we hit our daily ERL, which is the eventual take profit. Let's watch how price plays out. You can enter here or even here and just stop looking for entries once price has hit the ERL. Now, this is where most beginner traders fumble. They learn 90% of the step and immediately execute without taking note of the conditions necessary for a winning sniper entry. I want to share something that most people miss out on when taking entries like these, causing massive losses even though the setup seems profitable. These lower time frame trades must be executed within a kill zone or with news volatility. Now, if you're not sure how to use those, watch these videos here to get a full breakdown of the concepts. To simplify, the kill zones are periods of the days where volume is extremely high. These comes in during the Asian, London, and the New York session. The boxes over here that you see illustrates the kill zone, but you have to check the timing out based on your own time zone to have the most accurate data. I'm personally trading on the GMT +8 time zone. Now, that settles the low time frame entries. Simple enough, right? All we need to do now is follow 4 simple steps. So pay close attention. Step 1. Find your high time frame context, which is your IRL to ERL. Just to recap, internal range liquidity or IRL comes in the form of fair value gaps, order blocks, breaker blocks, mitigation blocks, and the likes. Essentially, it's areas of pending liquidity. Step 2. Time frame alignment with standard entries or clean traffic entries based on the graph above. Step 3. Enter the trade with stop loss above or below the most recent swing point, targeting your external range liquidity ERL for your take profit. Step 4. Now, this is a bonus step, so listen up. Follow the clean traffic price leg until you reach your external range liquidity, which is your eventual take profit point. Now, let's move on to what I've been loving recently. Swing trades. Swing trades are more of a set and forget type of trading style. Perfect for people with a busy schedule with multiple different jobs that want to have quick wins in the market. These types of trades will naturally take longer to play out, so there's no reason to be staring at the charts and watching paint dry. The difference between swing trades and lower time frame trades is that number one, you don't really need to pay attention to news volatility for entries. And number two, you don't need to trade inside a kill zone. If you see a setup, you can go right ahead and take the trade. Here's the main criteria for swing entries. So listen up. Swing entries must have a monthly, weekly, or daily context. Now, what do I mean by context? It must be based on a monthly, weekly, or daily IRL to ERL setup. Let's hop right into our first example of this swing trade. This is the monthly chart on GBP US dollar. And you can see right here, we have a monthly bullish fair value gap created by these three candles over here and a monthly swing high as shown over here. This is our monthly context. IRL based on monthly fair value gap to ERL, the swing high. Now, on the weekly time frame, we can see that price action here, we have formed a weekly fair value gap, formed outside of this monthly fair value gap. Later on, as weeks go by, we formed another weekly bullish fair value gap here. This is the part where I want you to pay very close attention to. The fair value gap here is considered a breakaway gap. A breakaway gap is a fair value gap that you do not expect a retracement into. Why? Because the third candle of this fair value gap closed very high up. So price has to do a lot of work to retrace back into this first fair value gap. This shows us extremely bullish intentions on the pound US dollar. Now let's drop down to the daily time frame. Here we can see that there are several breakaway gaps like these and these over here, which all have massive bullish candles with no signs of retracement until this one right over here. Notice, the third candle of this fair value gap formation closed very close to the fair value gap. This signals to me that the buyers pushing GBP US dollar higher have lost its steam, lost its volume, and price can finally retrace back into this area. So let's mark this out. We also have a daily swing high as a result of this, meaning that's our target or our external range liquidity to target. Now, our daily context is like this. The daily fair value gap to this daily high, which is our IRL to ERL. At this point, we have a monthly, weekly, and daily context, all lined up for bullish prices, making this an extremely high probability trade. The last time frame and our entry time frame to look at is the 4-hour time frame. So, from the daily bullish fair value gap marked out over here, we formed yet another 4-hour bullish fair value gap, as seen from the 3 candlesticks right over here. This again signifies strong intentions for price to push higher. Now, here is the beauty of swing trades. All we gotta do is set a buy limit at the start of this fair value gap with stop loss at the swing low. Since if price breaks past this swing low right over here, the trade then becomes invalidated. Now, take profit wise, we are targeting a 1:2 risk to reward ratio, because remember, we're doing a set and forget style of trading. So we want to target an RR that makes sense and is achievable, that doesn't stretch too far to ensure that we can secure our wins. Now, I'm going to challenge you by sharing a little bit of an advanced concept. If you want to refine your stop loss, like how I did, you can refine it to the candle body lows. This is a little bit more advanced, so if you want to be safe, just put it at these swing points. And soon after, in the next few candles, you can see that price actually smashed full take profit. Now, let's move on to our last and final example on gold, everyone's favorite. Let's start on the monthly time frame once again. We have this monthly bullish fair value gap created with these 3 candles right over here. Let's mark that out. We now also have a swing high. That settles our monthly context. Simple enough, right? Bullish fair value gap as the internal range liquidity and our swing high as the external range liquidity. And therefore, we expect price to move from the fair value gap to the swing high. Moving on to the weekly time frame, we again have a weekly breakaway gap from the massive bullish candle right over here. We do not expect price to retrace back into this, as bulls are signaling that they intend to push price higher. If price does retrace into this fair value gap, then we probably are no longer bullish. So now let's zoom into the daily time frame and let's take a look here. We have yet again another breakaway gap as seen right over here from this massive bullish candle, solidifying the bullish intentions of the dollar. Since it is difficult to trade breakaway gaps, let's zoom into the 4-hour time frame to see if we can get an entry. On the 4-hour time frame, we have this bullish fair value gap right over here above this daily breakaway gap. Since we have the monthly, weekly, and daily context all lined up, we can use this as a high probability entry. Remember, for swing trades, our goal is just to set and forget. So to trade it, place a buy limit at the start of the fair value gap with stop loss at the swing low, targeting a 1:2 risk to reward ratio. You could even be a little bit more ambitious with your targets and target the monthly ERL, because remember, the monthly context is still in play. And we would like to have to see a nice swing trade that could eventually run to the highs. So let's see how this trade plays out here. And there you go. Price smashes full take profit and of course also takes out the monthly ERL right over here. So we have gone through intraday trading and swing trading entries. Now let's dive into some common mistakes that most traders make with their entry models and how to avoid them. Now, one of the biggest mistakes is entering trades during a consolidation phase, when price is stuck between a premium and a discount array. This normally leads to a lot of choppy price action and unclear market direction, and you'll be stuck holding your position for an unnecessary long period of time. Now, if price is facing resistance on either side of the market, it is much better to wait for either of the premium or the discount array to be disrespected before looking for an entry. For example, on this silver chart, price is sandwiched in between a bullish order block and a bearish fair value gap, a discount and a premium array. Notice how long did price chop about and consolidated for. Price messed about for 5 entire days before continuing to eventually rally higher. Overall, these are the conditions you want to avoid. You either want a clear discount array or a clear premium array with no opposing arguments. The second and biggest mistake is taking shortcuts by skimming through higher time frame analysis. A comprehensive top-down analysis is essential for successful trading. Skipping higher time frame analysis can result in missing the broader market context and the key points of interest. It's like trying to get somewhere in the foreign country without a map. Without the bigger picture, chances are you're going to be lost. For example, this is the daily time frame. You'd probably think, oh, we are extremely bearish. But then you will have price reverse against you extremely quickly. All because you didn't check the monthly and the weekly time frames for PD arrays, which in this case is a monthly bullish fair value gap. So, as a reminder, always start with the monthly, then the weekly, and then the daily charts before narrowing down even lower towards the lower time frame like your 4-hour, 1 hour, and 15. This ensures that you're trading in the right context in line with the direction of the higher time frame trend and not against it.
Look, I understand that this is a lot to take in and it was worth your time to watch all the way to the end. If you're still unsure of how internal range liquidity to external range liquidity works, I strongly suggest you rewatch this video to truly understand the full strategy. If this video has enlightened you in any way, shape or form, make sure to smash the thumbs up button. I live stream every single day on YouTube, so make sure to subscribe down below to get alerted when I hop onto the live streams every London and New York session. Last but not least, do click the first link down in the description below to join our free Telegram channel where we send 5 daily analysis every single day to ensure you guys can catch the same trades that I'm personally looking at during the London and the New York session. With that being said, rewatch, internalize and backtest the strategy for yourselves, and I'll see you guys in the next video. Nick signing out.